What is going on, everybody? Welcome back to the channel. Today I'm going to be walking you through the full strategy which I use on gold and which has helped me to achieve some of these results in the live market. I'm going to be giving you the full trading plan which I use, the risk management strategy as well, along with any of the processes which I use in order to analyze my results and to improve. So this is weekly reviews, journaling, templates, all of that stuff I'm going to be giving you guys for free in this video. Before we start, don't forget to subscribe for more content like this, which I drop every single Friday on the channel. Make sure to like this video so that you don't miss out in the future. And let's head over to the charts now, and I will begin to break down the entire gold strategy which I use. Hey guys, so here it is, the full gold trading strategy which I currently use. Before we get into the trading plan, which I said I'm going to be giving you guys for free, I'm just going to quickly walk through some of the key concepts which I use and how I personally view the market. So starting off, we obviously need to know market structure, as is the fundamental part and component of this strategy which I'm going to be showing you guys. So if you are unfamiliar with this concept, this is basically how I view the market. So when price is in an uptrend, we're looking for BOS, which stands for break of structure, which is when price breaks the most recent high before the pullback, creating a higher high, and then we have a higher low and then another higher high once price breaks and closes above that most recent structure to the left. The other concept we need to know is what is called a change of character. I've marked it here as CHOC for short. And a CHOC is just simply a break of structure in the opposite direction to the trend. And this signals a reversal for us. So if price is in an uptrend as shown here, and then breaks and closes below the most recent high or low, that would be, for me, a change of the trend. And then we would go from looking for buys to sells. And then obviously vice versa if it goes from a bearish trend to a bullish trend. And with this strategy, it's important as well to note that we are only looking for trades which are in line with that overall direction. And essentially, we are just looking for a pullback into a key area somewhere within this leg of the trend. And then we're looking to continue buying. And this is simply just because pro-trend trades are higher probability because we have that overall fundamental and technical bias on the higher time frame in our favor. So yeah, I don't think we need to go through any other points on market structure. Very simple concept, and most of you guys are probably already familiar with it anyway. So the next component of the system, sorry if we just move that out of the way. So the next component of the system is this concept of liquidity. And this is where a lot of people go wrong with the strategy which I'm about to teach you, because liquidity, of course, is a very subjective thing in the market. You know, basically everything in the market is liquidity, but how I personally define it is any area where people were previously buying or selling from. What we have to understand about liquidity is that it's one of the fundamental drivers of the market. So for price to go higher, it needs to take out some people that were previously buying. And for it to go lower, it needs to take out some people that were previously selling. And we are, of course, looking to enter when these traders get taken out. So for a buy trade, we are looking for buyers to get taken out. And then once we see them taken out plus a reaction, we are then looking to buy up into some opposing liquidity. And what I've done here is just identified 4 of the main types which I currently use. Of course, you could identify more, but these are the key ones that we're going to be using in a moment when we get to the trading plan. So the first type is probably the most basic type, which everybody knows: equal lows and equal highs, which is essentially where we have a double top or a triple top, 4 equal highs. It doesn't matter as long as we have a clear area of resistance where people were previously selling. So what we've got to imagine here is that once price reached this point, all of the retail traders are taught to sell when we come up to a resistance level. So loads of people are selling in this one region, which means that there are a lot of orders resting above this area of the market. And likewise for some equal lows, we can think that lots of people were buying above this level somewhere, and their stop losses would be somewhere just below this area. So essentially what we're looking for is, in this sort of scenario, we're looking for price to come slightly lower, liquidate all of these lows, and then we are looking to get in the trade afterwards, provided that we have a few other confluences beneath this area as well, which I'm going to go into later on in this video. The second type, very similar to equal lows and highs, is just trend lines for the same reason. You know, every retail trader knows this concept, and that is precisely why it doesn't work. We have this trend line being respected multiple times. People are anticipating price to come back to the trend line and then to buy again. But what we know is that obviously that is too obvious in order to work. So instead we are looking for something like this, where we see price come slightly lower, take out all of that liquidity, and then we are looking to buy afterwards. Again, provided that we have a few other confluences below as well, which again, I'll go through in a moment. This one, type 3, probably quite unfamiliar to some of you, maybe not, but essentially BSL and SSL, buy side liquidity and sell side liquidity, is very simply when we have a pullback like this, which created a low. This retracement here was caused by people in the market buying, particularly if you look on the, say, the 1 minute time frame. The only possible explanation for the fluctuations on the 1 minute time frame is because people are buying in particular places in the market. This causes the market to move up, and because we have this, we know that there are people buying below this low, which caused this push up. So people have stop losses below this low. We are then looking for price to sweep this into our point of interest to the left, and then we're looking to buy. Likewise, if we have this where price is overall bullish and then we have this minor correction, it's because people are profit taking or selling at this particular level to the left. And if price is bullish, what we are anticipating is that all of this is going to get liquidated and price is going to continue in the direction of the prevailing trend. So what we want to see is for price to take out this high into an area of supply to the left, and then we're looking to sell down. And then the final type, which I'm going to be using for the strategy, is an inducement, which very simply is when price comes close but doesn't touch an area of supply or demand. So what we are anticipating in this scenario, much like the example that I showed above, they're basically the same thing. When we're looking for buys and price stops just slightly above the demand zone, we're looking for price to come down at a later date, or the same date but at a later time, sweep this low, come into the demand, and then that is when we are looking to get our entries. So yeah, that's really all of the liquidity concepts which I'm going to be using. I just want you guys to understand how I personally view the market and understand these types of liquidity before we get into the system itself. And then 3, supply and demand. I'm sure you guys are all familiar with this concept, but a few of the criteria which I use to identify valid supply and demand zones. So first of all, the definition: areas of previous buying or selling pressure. Demand area is where people were previously buying from and we see a lot of buying pressure come into the market. Supply zones, same thing, is an area where we see a lot of previous sellers come into the market. How I identify this as well is a bullish candle, which is preceded by a series of bearish candles which create imbalance. So we can basically see that the market came up, and then after that small move up, we get this huge sell-off. So our supply zone is this bullish candle right here. Likewise, for a demand zone, we want to see the candle which basically caused this push up. So we can think of it as the last bearish candle, as you can see here to the left, before this push up, which also created imbalance. And the second criteria we need to see as well is that it breaks structure to the left. So in this case, we can see that this break of structure stemmed from this area of demand, which brought in the volume to the market, which caused the break of structure. This supply area brought in the volume, which caused this break of structure to the left. And how we use this in the strategy, which I'm going to go through, is these areas of supply and demand are points of interest where we are looking to buy or sell from, because we can expect that because the volume came into the market at these zones before, that will likely happen again, and price will give some sort of reaction within these zones for us to continue buying or selling, depending on the higher time frame trend. And final bullet point is that we want to wait for the reaction in these zones rather than just set a limit on them. And that brings us to step 4, which is this idea of a confirmation entry. There are lots of different types of confirmation entries. You know, you could use one rejection. You could wait for a price to reject the area 3 times. You could wait for an engulfing candle. I've seen a lot on YouTube, but this is the one that I've back tested a lot and found to work best for myself. As I showed you guys the results at the beginning of this video, that was all from using this one confirmation entry in line with the higher time frame bias and in our higher time frame levels of supply and demand. So type 1 buy model, what we can see is that price is, so what we've got to understand as well before I say this is that the market is fractal, meaning that if price is on, say, bullish on higher time frame, when we get a retracement into our level, price is obviously going to be bearish on the lower time frame. So what we're looking to do is once price comes into our higher time frame demand, we're looking for the lower time frames to break and flip bullish. And how we know when the lower time frame has flipped bullish is because it will break and close above the most recent lower high. So we can imagine here we've got a sequence of lower highs and lower lows on the lower time frame. Once price comes into our demand, again taking out this area of liquidity which was above it, we then wait for a break of structure in the opposite direction to the trend. So we remember as well from the beginning that this is called a change of character, which I've just marked on with a C, just to make it a little bit more concise. We then wait for a retracement into a lower time frame level of demand. And the reason we do this is simply because we don't want to be buying all the way up here with a huge stop loss below the low, because this is essentially buying in a premium. We want to be buying in a discount. So we wait for a retracement and then we look to get in on this lower time frame level of demand, looking to buy up and then target some area to the left. Similarly, with a sell side entry model, price is coming into our higher time frame supply. On the lower time frames, price is therefore going to be bullish. So we're looking for a closure below the most recent higher low. We are then waiting for a retracement into a lower time frame level of supply to sell down to some previous lows. And this is essentially all of the concepts which I use and incorporate in the trading plan, which I'm about to discuss with you guys. So what we'll do now, we'll head over to the trading plan. I'll go through the trading plan itself, and then as we go through it, I will go through some examples on the charts to make this more concrete and easier to comprehend for anybody new to this system. So first of all, let's go on to the trading plan and I'll walk you guys through it. And at the same time, I'm also gonna just walk you guys through the examples as well so that I can better explain the trading plan. So the first example we can go through was, let's have a look, where was it? So obviously there are a lot of examples, but I wanted to find a perfect one for us to go through in this video, just to make it a lot more simple and clear. So let's go through this one, which I took last year. So first of all, step one, we are going to identify market structure and direction. And for this, I found it best to work with the daily and 4-hour charts. So in this case, all we do on the daily is we see that price is very bullish, therefore we're looking for buys. And then on the 4-hour, this is where we can draw on the actual market structure itself. So what we can see here is that if we just mark on the main structure points, we've had this break of structure just here. So the B stands for break of structure. I just like to abbreviate it slightly. What this means for us is that for the buys, we're looking between the low and the high of this range. And if price comes below this low, we would consider that to be a trend reversal, and then we would be looking for some sells. But we don't expect that to happen until price comes into a significant level to the left on the higher time frame. So for example, once this main liquidity level is taken, which was the current daily high, at the moment, if we're looking left, price is just in this random area. Price does not reverse from a random area. It needs to take out some higher time frame liquidity or come to an area of higher time frame supply for it to reverse and flip bearish. So considering all of that, we are expecting price to continue bullish. A higher time frame is bullish, and at the time the fundamentals were aligning with that narrative as well. So what we are doing, we are only looking for buys. I'm not looking to sell down to a point of interest. I'm only looking for buys. So during this whole retracement here, which was 3 or 4 days worth, I would basically have just stayed out of the market, waiting for the retracement to complete into an area of interest, and then I'd be looking to capitalize on the buys. Which brings us to step 2 of the trading plan, which is to identify a point of interest. Of these, I have 2 types. For this first example, we're going to be focusing on type 1, which is an imbalanced level of demand. So let's have a look what we have here. We have this level of imbalanced demand, right? Because this was the area of demand which created this imbalance and led to the breaker structure to the left. We also have this one down here. So I would also have marked that on. And one point to note as well is that because we don't know where price is going to react, either from this one or completely reverse and break these lows, we want to basically be reactive to the market rather than predictive. Essentially meaning that, instead of saying, if price comes into this level, I'm going to buy because I think price is going to buy from this level. We wait for price to come into this level, and then we wait and see how it reacts to that level. And this is basically the reason why we use the confirmation entry, because we're waiting to see how price reacts rather than just predicting the reaction. Because it could have also happened that price simply melted straight through this level, and we were trying to predict price going bullish at this level, when in actuality price may want to continue lower. So yeah, that brings us to step 3. Lower time frame entry model. This is the same entry model that we just went through during the presentation. So lower time frame entry model, that obviously depends on, so you may ask, what time frame is the lower time frame? So the entry time frame depends on the time frame on which we identified the point of interest. So if the point of interest is on the 4-hour, which in this case it was because we identified this 4-hour demand, we go down to the 15-minute time frame for the entry. And likewise, if the point of interest was identified on the 1-hour or the 15-minute, we go down to the 5-minute for our entries. Exact same entry model, just the time frame differs depending on the time frame on which you identified the point of interest. And yeah, all we do, go to the lower time frames. We then want to see the most recent structure broken and closed above. So right now, in this case, what we can see is that the 15-minute was bearish. So if we just draw on some of the structure, we can see that price is printing lower lows and lower highs. And based on this, we want to see this most recent lower high broken and closed above, followed by a retracement, and then we're looking to buy up to these previous highs because price is bullish on the higher time frame. So we are expecting price to continue with that overall trend, considering that I didn't come into a significant level to the left as we discussed. So at this point in time, I would just be monitoring price, waiting for the confirmation. But what we can see price has done now, instead of creating a higher high and breaking above this area, it formed a new lower low. So it formed a new lower low, like so. So what we're waiting for now is for price to break this high, and that would be our confirmation. So let's see if price does that. Nope, again. So now it's formed another lower low. So in this case, we're waiting for this level to break. And again, we're still waiting for, if we draw this on, we're waiting for this high to break. That would be our confirmation. And there we go. We have a 15-minute closure above the level. Notice how this closed above and didn't just wick above. That is a good sign. So we can mark this on with a C. Again, that stands for change of character. And at this point in time, what we are asking ourselves is there an area of lower time frame imbalanced demand in a discount where we could look to buy from? Going back to the presentation, you remember that we don't want to just do this and buy as soon as price breaks that level, because look at how big the stop loss is. We would have to have a huge take profit in order to secure a 1 to 3. And on top of that, most of the time, once this high is taken, price will retrace because it has taken out some liquidity. That's just the way the market moves. So if we get the fib tool and we draw from the low to the high, we are essentially looking for price to come into a discount, which means that we're waiting for price to retrace into the 50% level or below. And what we can see that aligns very nicely with that level is this area of 15-minute demand. Why is this a demand level? Well, you can see a lot of bullish volume came into the market from this level. We have this imbalance here as well, and we have liquidity resting above it in the form of this low. What does price need to do before it goes higher? Take out some previous buyers, which we have just here. So what I would do here would just be to set a limit on this zone. I'd have target stop loss just below here in case price wants to take out this wick. If it comes below that, then it's going to probably take out this wick, in which case the analysis was wrong and we want to be out of the trade. And I missed out one thing, which is where we are targeting. And for this strategy, we are simply going to be targeting a 1 to 3 risk to reward. So ignore this bit. This is one of the discretionary rules that I have. But for this, I want you guys to test it with simply using a mechanical 1 to 3 take profit rule. So if we drag this up to a 1 to 3, it also aligns very nicely with this high, which is obviously an area of liquidity in the market. So after this goes, you may very well see a reaction for price to retrace lower before going higher or reversing back to the lows. So now that we've got this set, let's see how price reacts. There we go. Let's see if price reacts at that high. Yeah, so there you go. Once this high gets taken out, you see a pullback. Still expecting price to continue up, but I would anticipate maybe a sweep of this low, first of all. Yeah, so there you go. That's the one thing about liquidity. Once these highs are taken out, you expect a sell to take out previous buyers. Like I just said here, I said a sweeper this low, and then you get the continuations higher. Point being, if you can't handle seeing price go from 4% to less than 2%, then I would get out of the trade at these previous liquidity levels. If you are, psychologically trained enough to do these, to hold through this, then, you could instead target the higher time frame high up here for a much bigger risk to reward. But personally, if you are new to this strategy, I would recommend just targeting a mechanical 1 to 3, or at least just target the next liquidity level. So yeah, that's example 1. Let's go over to another example now, and this time we will look for a sell trade. And again, let me just find a perfect example. So this whole year, gold has really been bullish the entire time. So there weren't really many bearish trades, at least on the higher time frame. So where was one that I took? So right here. Okay, so if we're focusing on this price action, we can see that the 4-hour trend is currently bearish. We've had step 1, identify market structure. 4 hours bearish. We can then draw on this as the most recent break of structure. This was the most recent lower high. This was the lower low. So in order to sell, we're looking between the high and the low. Going over to the lower time frame, let's identify a valid point of interest. So what we can see is that we have this hourly level of supply, and what do we have below it? We have an area of liquidity in the form of this high. If instead price had done something like this, I would have counted this supply as a valid point of interest, because if it had done this, we would have had a liquidity area resting below it. But since there is no liquidity between where price is now and this area of supply, this area of supply is not a valid point of interest. I would anticipate that you would see a small reaction from this level. So something like this. But I would expect price to, in the end, rally through that and come into that more premium level of supply, just above. So if we play price, yeah, so there you go. You have this small reaction, but then ultimately price comes higher to take out some of the liquidity to the left. So if we change the color of this, remembering that if we just rewind this as well, this point of interest was drawn on the 1 hour time frame. So for our confirmation, we are going over to the 5 minute time frame. Give me a second, I'll just be back with the FX replay chart instead, because this data point is unavailable. Okay, so back to what I was saying. Price is in our area of supply. We're overall bearish. Price swept the liquidity to the left, and this was an hourly level of interest, point of interest. So we're going down to the 5 minute to execute our trade. And in this example, what we want to see is price break the most recent higher low. So looking on the 5 minute, we can see that price was in this bullish trend as it approached the point of interest. So what we want to see broken is this most recent higher low. There we go. So we got a break of that most recent higher low. Where was the area of supply which caused this break of structure? It was this area of supply, which you can see more easily on the 15 minute. You can see that we have this one bullish candle, and after that candle, we got this huge sell-off where all of the volume came into the market. So I would set a limit at this level of supply. stops just above the high, and again we're going to target a 1 to 3, which is just there. What we can also see now is that price has generated some equal highs just below that level. The fact that we now have this just makes it higher probability, because when price takes out liquidity, even if it's not going to do a complete sell-off back towards the higher time frame low, you will almost definitely see some sort of reaction from this level. So if we play price, let's see if it can pull back into our zone. So since price did this, you could now target either this low, or you could stick to the 1 to 3 target. But there we go. Price has come into our level. If you wanted some more confirmation that this level was going to hold, you could have got another confirmation entry. So you could have used this as the 15-minute point of interest, gone down to the 5-minute, and saw that once price came into this level, it broke 5-minute structure, and we have this area of supply that was created. We have some liquidity below it in the form of this high and this sort of trend line as well. It broke structure, created imbalance, so we could set a limit on this zone if we either missed the first entry, or if we wanted more confirmation that this level was going to hold. And again, we're just going to target the low down here, or you could go with the 1 to 3 mechanical take profit rule. And there we go. So the second entry would have been tagged in. Note as well that I would not have entered this if I was already in the first trade, because that's just doubling the risk. And you couldn't have made this trade break even because the entry price is essentially the same. But yeah, take profit hit on that one. So just a quick walkthrough once again. We identified that the 4-hour was bearish, drew on the market structure to identify the range that we're looking to sell within, between the high and the low. We then dropped to the lower time frame to see if we could identify a premium point of interest and area of supply, which we identified this level, which had the liquidity resting below it. Once price came into our area of interest, we dropped down to the lower time frame, in this case the 5-minute, because the point of interest was on the 1 hour. We waited for price to break the most recent higher low, telling us that it wants to move lower and that it has flipped from bullish to bearish structure. We then set a limit on the area of premium supply, which caused the break of structure and had liquidity resting below it as an extra confluence. And that is all there was to it. We targeted a 1 to 3, but you could have also targeted the most recent low, because you know that, like I was saying before, once this low gets taken out, price is very likely going to retrace because an area of liquidity has been swept. And let's just see if that theory played out. Yeah, so you got this sort of small retracement. Let's have a look. Yeah, so there you go. After that low was taken, you got a bigger pullback, pretty much back to the entry level. So it is always safer just to target a 1 to 3 or target the most recent liquidity point, rather than targeting all the way down here, unless, like I said, you want a lower win rate and you are able to handle price pulling all the way back to entry once it already hit a 1 to 3. Personally, I wouldn't allow that to happen, and you could maybe experiment with a break-even rule. For example, if price does hit a 1 to 3, make the trade break even and then just let it run. But yeah, that's everything there is to this strategy. Before we end the video, one final thing I wanted to touch upon was the risk management strategy. So the risk management plan, I've made this as concise as possible. So 1% risk per trade, and this is the same whether we're on a losing streak or a winning streak. So in essence, don't let your historical results dictate what percentage risk you use per trade. If we have 5 losses in a row, we are not cutting the risk out of fear. And if we have a winning streak, we are not doubling the risk because we're overconfident. It's important to retain that sort of objectivity and mechanical rule in your trading. And one other rule that I have is I don't place trades immediately before or during high impact news. So the main ones being NFP, FOMC, CPI. Which other ones are there? Interest rate decisions, GDP data. Those are the main big ones that I can think of right now. But yeah, so you don't want to have price activate your limit during a news event because, like I've explained here, news trading is simply a losing game because even if you win the trade, your risk to reward ratio becomes such that over a large sample of trades, you aren't going to be profitable. Because think of it this way, normally we are risking 1% to make 3%. And let's say we have a 40% win rate, which is realistic. During news, because we have the risk of slippage, which is when price doesn't respect your stop loss because it's moving too quickly for the broker to trigger your stop loss, it's actually the case that we're risking 2 or 3% to make 3%. With a 40% win rate, if we are risking 2% to make 3%, we are at best going to break even. And if the slippage is really bad and we're risking 3% to make 3%, then we're obviously going to lose money with a 40% win rate. So there's not much point trading news. Even if you get lucky once or twice and catch a NFP or CPI move, over a large sample, you're probably not going to be profitable trading news. So I would just stay away from it. As I said in the video, we're going to use a 1 to 3 target, so a mechanical rule. No break even. So I just let the trades run to stop loss or until they hit a 1 to 3. And this is backed by data, by the way. I found that when I make trades break even, I actually make less profit than if I were to just let the trades run. Maximum 1 trade in a day. So I think for the majority of people, if they lose 1 trade, then they cannot execute the next trade with the same mental clarity and logical thinking that they would have executed the first trade with. And this isn't really their fault. This is just a human problem. Very few people have that sort of psychological discipline in order to do this. So I'd recommend just for most people to don't re-enter trades once you lose, and have a maximum of 1 trade per day. Me personally, I only end up taking around 3 to 5 trades per month, and this is more than enough in order to make a decent percentage return. Remember as well that it's not about how many trades you execute, it's about the quality of the very few trades that you do execute. And executing more trades does not mean that you will make more profit. So closing point, focus on 3 to 5 trades per month and focus on quality, not quantity. And more trades does not mean more profit. You could take 100 scalp trades that are all low probability and lose all of them, or you could take 1 very high probability swing setup for the whole month, make 3%, and then you're doing better than pretty much all of the traders out there. If anybody tells you that 3% per month is a bad return, they're not a real trader. just remember as well that the benchmark we're measuring our returns against is the S&P 500, which on average does an annual return of 8%. So if we're making 2 to 3% per month, we are beating that. Obviously, this is realistic because Forex is a lot more risky than investing into the S&P 500. So we want to be compensated for the extra risk. It's called a risk adjusted return or a risk premium. Okay, so that was the full strategy which I used to trade gold. If you guys enjoyed this video, make sure to subscribe for content like this, which I drop every single Friday. And I will see you guys in next Friday's video.